Tanae asks, would you consider walking us through what you saw on order flow during Friday's session as the price action approached the bear zone at 42.70? I personally missed the trade because I was not seeing anything meaningful on order flow. I just need to get better at it. And subsequently kept waiting to see what might happen once we were in the bear zone. Appreciate any insight you might consider sharing. So let's just share this little guy here. Okay, so my memory is absolutely terrible. Let's try to figure out what our read was on Friday. Let me pull up the DMI that I posted or something, get a refresher here. Is that the picture is worth 1,000 words? No. Okay, so nice bear line in the sand. It was from 70 to 85. So ignore the lines here. In fact, I can just, well, I'm not going to change them. I'll change them. I'll change them. I'll change them. I'll change them. I actually don't know how to do that anymore. Here it is. I don't know Sierra's menu anymore. I'm like a brand new person with it. So we had a bear zone from 70 to 85. Something like that. So these time range highlights are off. So the open is actually like right here. So disregard that. So so the question is around the order flow coming into that zone. It's bullish. The order flow is bullish there. There's no question about it. So what this brings about for myself and my traders, and we have conversations around this, is, and my students even, right? We talk about, I was just off on a call talking about this with Mike, the hierarchy of order flow, the hierarchy, right? It's NADR, then O, very last. So if the narrative is good enough, I don't care what the order flow says, right? If it's a weaker narrative, something we're less confident about, then the order flow is kind of the tiebreaker, right? That either says, go for it. It's a great idea here. It's worth it. Even though maybe there's some dissonance, maybe you're compromised, maybe the narrative read isn't as strong, whatever. This was not that case. This was crystal clear. All my students know this, okay? This was fantastic bear zone, huge opportunity, great stuff. So the fact that Delta, takes over on the positive side and is ripping higher on this 3-minute type chart, don't care. That is the difference. Not all of these moves into highs like this and whatnot are created equal. Now, we could assess the delta further, and in fact, if we go to let's say 3,000 volume chart, And you guys are seeing this chart, right? I just want to make sure I'm sharing the right thing. Okay. Here it is. Take a look at what happens here on a more granular order flow level. We trade up into an area. As would be expected, we've made a nice rotation here. The buyers start to dry up. They get tired. The sellers try to push. This, in my opinion, is kind of capitulatory, right? It's no different than other highs and lows that we see at areas where you're late in a rotation and you see a flurry of activity that, importantly, is quickly reversed, right? So what happened is that the buyers from this point forward, right, just this little bitty move higher than where we were in terms of price, they really aggressively press all the way up to, whatever this level is, 6,400 on Delta. And then there ends up being on this positive bar, okay, let's really zoom in here. This bar ends up with negative Delta. And then this bar that starts to sell off in terms of price, they're really starting to press it, right? So there is something there, even though it depends on what time frame you're looking at. It depends on how granular you're looking at things. But on like a 3-minute chart like we were looking at, it just looks like, okay, strong buying into this area, but I don't care because this is a beautiful spot to get short. If we get more granular with it, I think there was a little bit of capitulation and a nice beginning of reversal of sellers showing us, hey, this is an aggressive spot, or excuse me, this is a spot we'd like to start getting aggressive. So hope that gives you a little additional insight on what I think about that sequence. Christine says, what do you need to see to qualify a fade trade against the narrative for the session? First of all, Christine, wasn't it you I talked to last week? I think it was Christine. Anyways, I'm sorry if I'm forgetting names. I think it was you. Anyways, you guys catch the recording when it's up. We actually unmuted Christine last week and we talked about our mental framework and stuff. It was an awesome conversation. Christine, you need to be a NADRO student. You don't have to answer. You don't have to respond to this here publicly or anything, but let's get Ryan to reach out to you. Let's get you a big fat discount on it. But you've shown such dedication and asked such good questions with us for so long. Let's find a way to get you this course and get you into our community. So I did, whatever that requirement is, let's do that. So I'll ping Ryan and get him to reach out to you. So what do you need to see to qualify a fade trade and against the narrative? So the answer number one is study the heck out of the course and learn everything you care to about that, and then work with everyone in our community to get good at it and understand it deeper and everything. Here for today, what I would say is, so if I, for example, was like last Friday where we had the bear zone, but I saw an opportunity to get long before we got to the bear zone. That's what I think we're talking about here. For me, I call that a scalp. It's not supported by narrative. It's going to be short-term in nature. It's going to have order flow supporting it. It's going to have rhythm and DVA and the other things that I use supporting it. So it just doesn't have the narrative component, and it's going to have a minimum risk reward runway for me. Okay. I'm not going to take a scalp trade in the face of narrative at the critical inflection itself. That's dumb. I'll take a scalp getting into or heading towards an opposite narrative inflection if I have risk reward on the table to do so. So I take those trades less frequently. They have to be good short term because guess what? They're not good long term. So it creates a different priority for something like order flow, right? We just got through looking at a fantastic narrative short trade location, and we talked about order flow and how, you know what, screw order flow, right? For a scalp, we never say screw order flow. We want to align with what's going on very short term because it's a shorter term trade. So those are some things that I need to see for that to make sense. Good question. The new way that you have the desk trading using in a narrative only, do they still scale out or just go for 2-to-1 or more? So first of all, not everyone who trades for me trades in that new way that you're referring to, just to be clear. But I do have a handful of junior traders who are still, for example, phase one, as we call it, only kind of trading narrative, market profile, stuff like that. They're not using short-term timing. Yes, to answer your question, they still scale out. Yes. Some of them, I told them I don't care how they manage those trades. They just need to meet some risk reward requirements for me to say that their trading looks good, or their statistics looks good. So the ideas need minimum risk reward, but how they end up either scaling or going all in, all out, or whatever they want to do there, I leave that up to them. So different people doing different things. Speaking of scaling, Alan says, hey, Merritt, can you talk more about your scaling out strategies? Do you go half scale, half core, thirds, etc.? Also, what size do you start running into slippage or other liquidity constraints for ES and CL? I've traded 100 lots, just market ordered. That's no problem in the S&P. It's really no problem in crude. I don't really do that often. I've done it. No, I was about to say I did it in the Russell, but that was actually in 10 unit clips rather than banging in for 100. So it's just not really a problem, man. These markets are even deeper than I think a lot of times we think they are. Like, for example, I don't have a dome up right now, but I guarantee the S&P is like what, 14 by 22 by 30 by 10 by, you know what I mean? It's extremely thin compared to like 1500 by 800, which is kind of like historically more normal for the S&P. There's even in these thinner markets. I mean, when we're doing like 1.5 million, 2 million contracts a session, there's so much liquidity there, even where you might not think there is. So I don't really, in fact, even if there is some slippage, I'm not afraid of slippage because I'm getting screwed either way. Either you bang in with size to where you move a market 2 ticks, who cares? Okay. I'm not playing a game of ticks here. Or you piece in with whether it's algorithmically or manually. I typically just do it manually. For those of you who've watched me trade, you'll hear my keyboard go do 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 do, right? I was actually a little known fact, from 8th grade until 10th grade, or was it 11th? I think I quit band after, I think it was after 10th grade. Anyway, it doesn't matter. I was the section leader of the drum line. Started out on bass, went to the quads, and then I was section leader snare. And those skills, actually, believe it or not, with my hands and fast, rhythms and stuff like that, they actually help me out banging in quickly to, like, I can tap out beats and things like with one hand using like all 5 fingers and the thumb and stuff like that, just from those drumming kind of skills. And so I like to just, if I want to get into 25 lots, I might just put it on 5 and just, just real quickly, just kind of, and I have a lightning fast, mechanical gaming keyboard for that and stuff. So anyways, liquidity is really not a problem for even a large trader. It's just not. Liquidity is a problem for hedge funds. They're having to really think about how to efficiently get into thousands of contracts versus me getting into 50 or something. It's just not a big deal. What is a neutral zone for you? What's the difference between a bullish, bearish line in the sand and a neutral area? That's a great question. So neutral zones are important enough. Call them support resistance. Okay. We're bullish them if we're above them. We're bearish them if we're holding below them. Okay. Just like normal support resistance. That's what they are. Areas that have a color that are bullish or bearish lines in the sand, they have a greater meaningful driving force to the bias that I have for that session, as long as those levels are being held above or below. And they have contextual shift, bias shifting areas, implications when they are violated, aka if we are below it and then we start to hold above it. The neutral levels aren't going to have that much as strong of an implication. So for example, if I have a bear zone, yes, people can see my whiteboard, move that. Here, actually I want to draw that lower. So if I have a bear zone here and a neutral zone here, this is a bearish, it fails, so this becomes bullish, right? Well, guess what? This is a second chance opportunity to get involved with this idea, because now we're holding above a neutral inflection. That's great. This is not a really strong short opportunity. The fact that the neutral zone failed and we hold below it. Why is that? That's because this bigger picture thing relative to the big picture, like key actual directional bias level, which is now bullish, that's more important than this. So it gives you a hierarchy of the levels in addition to giving you a directional bias that I'm leaning on at any point in time. YQY says, new guy here. How do you define reading the tape? I saw a mini tweet mentioning dome, footprint, etc. What do you use specifically? Delta, if I understand from your tweet yesterday. From my trading at this point in time and over the, I don't know, I'm losing track of time, maybe the past year, it's exclusively cumulative delta. That's my order flow tool of choice. Over the past 10 years, the bulk of that time, I have actually used a footprint chart in addition to delta. But for me, I don't look at a dome. I currently don't look at a footprint chart. I just look at cumulative delta. Julian says, could you talk through how you approached today? Sure. So today I had a couple bear zones. I didn't do a DMI today because it wasn't meaningful enough, but for my own purposes, I had, as I'm sure students on this call could guess, I had a red line at 41, was it 76? And I had a red zone up at 42.10 to 42.25. That's what's currently on my charts. And I had an important neutral zone, I'm sorry, at a 41.92 area. So, but little known fact, I actually went swing long Sunday night. So I sold puts and have been essentially delta hedging wherever I saw the short-term market that I thought was going down. I would sell futures against those short puts to neutralize that downside exposure. So, you know, for the past 2 days, not just today and yesterday, what's happened is I've been profitable on put positions, and I have exited that today into that kind of first bear area I told you about. And I've been profitable on the short outright futures when I've put those on, both days, in fact, not just cumulatively for the 2 days. Each day made money on puts, made money on short futures. So today we opened up kind of rotational intraday, right? With not, you know, no real strong narrative, no great DMI, right? But still bullish, still looking for at least 41.76. Okay. That's kind of been the my read the past 2 days. So today I just took a few shorts intraday as we were kind of choppy rotational there for the first, from overnight all the way up until we broke up in around 10 a.m., you know, when I'm like exiting the puts, or buying back the puts, I should say. So I just shorted a few times from, you know, some of the highs, kind of a flaggy one from VWAP. I think I shorted maybe around 840 or so. I don't have the platform up right now that has my fills on it. I just have up my Sierra chart. So that's like my options trading and hedging platform is the other one. I use CQG. So that's what I did today. That's what I've done the past 2 days. All right, we got time for one more question here. Let's take one from Duke and Duke here. Sorry, guys. I know there's a lot of good questions here. There's 1, 2, 3, 4, 5, like 8 we haven't gotten to. But Duke and Duke, Merritt, how confident do you have to be? This might be a deep question here, because I don't know how much confidence actually comes into play for my trading. But let's read the question. Let's share what I know about this, or how I approach these concepts. How confident do you have to be in a setup to put on large size? Is it a feel thing or strictly mechanical for you? So I would say I lean more towards the mechanical. But it's not that I trade in a mechanical fashion, far from it. I'm extremely discretionary. I teach framework-based NADRO, you know, methodology, which no one can take and go code up. By the way, if anyone wants to question why I teach a methodology, because anyone who does that doesn't actually have edge. Why would they do that otherwise, right? Well, I have different incentives than most people. Number one, I actually like to teach and coach. Number two, and I need to develop traders with edge to then back them to grow my business of a proprietary trading desk. So, you know, those are my reasons for doing what I do. And most importantly, maybe the reason that it can work is because no one can take my course and arb away my edge. No one can do that. It's so frameworks based. It's not one market. It's not one time frame. People develop specialties within the NADRO space. It's not one thing. Now, granted, our contextual reads, if we're using the full kit and caboodle of all the time frames that I teach, our contextual narrative read, like you should be able to come up with my DMIs for yourself on a day-to-day basis. Sure, at the beginning, are you going to get some wrong? Yes. Okay, but guess what? It's hard and you're learning how to do it. So, but anyways, ask any handful of students of mine who've been around for any period of time, I promise you, you take the Nadro course, you can 9 days out of 10 come up with the same DMIs that I do. So anyways, let them know in the chat, guys. You know, that's, you can confirm that that is the case. Anyways, I'm not trying to sell a course here. I'm just saying what's what with how I think about these things. So anyways, back to the question at hand. I am very discretionary within a very discretionary methodology in terms of decision making. I am very mechanical in terms of risk, but I'm not mechanical in terms of risk. And what do I mean by that? I don't just risk, let's say, 5 points in the S&P every time I take a trade. I'm discretionary with where the stop goes, but I'm mechanical with risking a certain dollar amount per trade. That means my size varies based on the distance of my stop. So I'm mechanical, but discretionary at the same time. So I like to have a consistent risk. I do not agree. My tweet yesterday about how I don't agree with 9 out of 10 things or 8 out of 10 things that I read on Twitter. I really mean that. People make posts about how it's all about sizing up in your best trades and that you should have trades where you're huge in because that's, you know, whatever. That's bull crap for a chart-based, technical-based trader. If you've got additional edge with fundamentals or where you have a certain catalyst or certain different things, yeah, there are times where the edge is so huge, you probably size up in those trades. And then guess what? A lot of other people just put out like feeler trades, which they probably shouldn't, but they do. And so they size those like 1/10 of the real A+ trades. I don't agree with that at all. I don't. I think there should be a delineation between where it's worth risk to put on a trade and where it's not. And I think that nobody knows which ones are going to work and which ones aren't going to work. So why would I want to have, out of sheer luck, by the way, the one that doesn't work be for 10x loss and have to take 10 1x winners to even break even? That is so dumb for a technical based trader who's just taking chart based, technical based setups. Okay. If you're able to arb something and you know you've got different kind of edges out there that I'm talking about, feel free to do things differently. But almost everyone on this call, I guarantee you, is either systems-based technical or discretionary technical. And I think it, and I've had conversations with Dr. Steenbarger on this. He'll back me up on this. The outcome of the next trade is random. So why would you want to 10x your risk on one trade on the next one just because you have a high confidence rating on it? And again, this may be a little philosophical, but ultimately, I think people who do that and do it successfully, they shouldn't be taking all the other small risk trades. They're probably net losers in those trades, but it doesn't matter because they're so minuscule compared to the large press the big size trades. Those are the only trades they should be taking are the big ones. And therefore they end up at the same place that I'm at, where you have a big risk that you like to take, which is your standard risk. So anyways, that's my take on that. Great question though. Hopefully some of that is helpful for some of you. I love it. All right, guys. Sorry we didn't get to all the questions. If you reach out to support@apterostrading.com, you can get info on where you can watch the recordings, all that kind of stuff. Any questions about Nadro or anything that we're doing. Have a great week. We'll talk to y'all next Tuesday.